On January 20th, 2026, the yield on Japan's 30-year government bond moved in a way it had never moved before. The jump was violent enough that it triggered an emergency call from the US Treasury, not a scheduled check-in, an emergency call. And if your first reaction is, why does a bond market in Tokyo warrant that kind of response from Washington? That's exactly the right place to start. Your mortgage rate, your 401k balance, the interest rate on a car loan. These feel like local prices set by local decisions. They are not. For decades, one of the most powerful capital flows on the planet ran straight out of Japan, directly into American markets, and quietly kept your borrowing costs lower than they had any right to be. That flow is now reversing, and the place to understand why is a number so large it barely feels real. You've probably never connected Japanese monetary policy to your own finances. That's a completely reasonable position. But here's what this video is going to show you. There is a 30-year financial arrangement now coming apart that changed the cost of money for every American borrower. Understanding how it worked and why it's ending changes how you read every interest rate decision that affects your life going forward. My name is Alex, and if you've ever looked at your mortgage rate, your monthly payment, or your retirement balance and felt like something shifted that nobody fully explained, stay with this, because by the end of this video, you'll understand exactly which mechanism changed, why it's not coming back, and what it means for every borrowing decision you make from here on out. It starts with the scale of Japan's national debt and what one country's financial experiment quietly did to ours. Pick any number that makes your eyes glaze over, and Japan's debt figure is probably it, 260%. That is the country's debt-to-GDP ratio as of early 2026. And if that sounds like an abstract statistic from a textbook you'd never pick up, give me 60 seconds. Because this number is the foundation of everything that's about to affect your mortgage rate, your retirement account, and the cost of borrowing money in America. GDP, or gross domestic product, is basically the total value of everything a country produces in a year. Every good sold, every service rendered, every paycheck earned and taxed. It's the scoreboard for the whole economy. When a country's debt is 260% of that number, it means the total debt is more than 2.5 times what the entire economy generates in a full year. That's not a red flag. That's a 5-alarm fire that's been burning for 30 years. To make it feel real, imagine a civil engineer in his late 30s. He pulls in about $94,000 a year. Solid income. He's doing the right things, maxing out his 401k, paying the mortgage, saving on the side, and then you find out he's carrying $244,000 in personal debt. Not a mortgage, just debt. Credit lines, obligations, money owed. Just the interest on that, at even a modest rate, would run him somewhere around $9,000 to $10,000 a year. That's nearly 10 cents of every dollar he earns before he buys groceries, puts gas in the car, or pays a single bill. Now scale that up to a national government. The math doesn't get kinder at a larger size. Here in the US, we're sitting at around 125% debt to GDP as of 2026, which, for the record, is not something to feel great about. Most economists start getting uncomfortable somewhere around 90%. We blew past that a while ago. But Japan crossed that line in the early 1990s and just kept going. No reversal, no dramatic restructuring, just more debt, year after year, quietly piling up. Now you're probably thinking, how does a country carry that kind of weight for 3 decades without collapsing? That's exactly the right question. And the answer is not discipline or good governance. It was something much more specific and a lot more fragile. Japan kept interest rates pinned near zero. When you owe that much money, the interest rate is the only number that matters. At 0%, a mountain of debt is manageable. At 3 or 4%, that same mountain crushes you. Think about it like a 30-year fixed mortgage. The house price is the same either way, but the rate is everything. A $300,000 loan at 3% costs you about $1,265 a month. At 6%, that same loan is $1,799. Same debt, completely different life. Japan understood this equation better than anyone, because for them, a 1% rise in borrowing costs doesn't add a few $100s to a monthly payment. It adds tens of billions of dollars to an annual interest bill the government is already struggling to cover. So they did whatever it took to keep rates at the floor. And that strategy worked, until it ran into something it couldn't control. that something was inflation, and understanding how Japan tried to fight it for 30 years, using zero interest rates and a policy called quantitative easing, is where the story gets genuinely strange. Here's something that almost never gets mentioned when people talk about Japan's debt. The country wasn't drowning in debt because it was reckless. It was drowning because it was desperate. And the thing it was desperate to escape wasn't inflation. It was the opposite, falling prices, a condition called deflation. And if that sounds harmless, almost welcome even, it's one of the most destructive forces an economy can face. Back in the early 1990s, Japan had one of the most spectacular asset bubbles in modern financial history. Property values in Tokyo at the peak were so inflated that the land under the imperial palace was theoretically worth more than all of California. Then the bubble popped, hard, and what followed wasn't just a recession. It was a slow, grinding, deflationary trap that lasted the better part of 3 decades. Here's how deflation actually works. When prices start falling, people wait to buy. Why buy a car today if it's going to be cheaper next year? Why expand a business if your revenue is shrinking, even when sales are flat? That hesitation ripples through every layer of the economy. Businesses stop hiring, workers stop spending, prices fall further, and the cycle feeds itself. It's not dramatic like a crash. It's quiet. Death by 1,000 small decisions, each of them individually rational, collectively catastrophic. To break out of that cycle, the Bank of Japan did 2 things. First, it dropped interest rates all the way to zero. Then it launched a program called quantitative easing. That phrase gets thrown around a lot without much explanation, when what it actually means is this: the central bank creates new money and uses it to buy government bonds directly from the market. It's not printing physical cash. It's expanding the balance sheet, adding zeros to accounts at the central bank. The effect is the same: more money in the system, lower yields on government debt, lower borrowing costs across the board. The logic was sound. If you make money cheap enough, people will borrow it. If they borrow it, they'll spend it. If they spend it, businesses grow, wages rise, and prices stabilize. The deflation breaks. That was the theory. And for a while, it kind of worked. Except Japan needed more and more of it to keep the same effect going. By the time you get to the mid-2020s, the Bank of Japan's balance sheet had grown to a size that would have seemed fictional 20 years earlier. At its peak, the central bank owned more than 50% of all outstanding Japanese government bonds. More than half. One institution, one country, holding the entire interest rate structure together by sheer force of accumulated purchasing power. That's not a market anymore. That's a controlled environment. And controlled environments are stable, right up until the moment they aren't. Now, a marketing director in his early 40s, living outside of Chicago, refinancing his home in 2021 at 2.8%. He has no idea any of this is connected to his rate. Why would he? The link is invisible. But here's the mechanism. Japanese institutions, flush with cheap yen and nowhere productive to invest domestically, started moving enormous sums of money into U.S. Treasury bonds. That buying kept American yields suppressed. Lower yields on treasuries meant lower mortgage rates. His 2.8% refinance was, in a very real sense, partially subsidized by Japan's domestic policy. That river of capital flowing from Tokyo into American markets had a name. Traders called it the yen carry trade. And for 3 decades, it was one of the most reliable, most profitable, and most quietly consequential money flows in the entire global financial system. Some of the most consequential financial arrangements in history have also been the most boring to explain. The yen carry trade sounds like something that would put you to sleep in an economics lecture. But strip away the jargon, and what you're looking at is one of the cleanest money machines ever assembled. One that quietly shaped American borrowing costs for 30 years, and is now coming apart in real time. The mechanics are straightforward. Japan has interest rates near zero. The United States has interest rates meaningfully higher. If you can borrow in the cheap currency and invest in the expensive one, you pocket the difference. That's the whole trade. The elegance of it is almost offensive in its simplicity. Here's how it played out in practice. A large Japanese pension fund, the kind managing retirement savings for millions of workers, could walk up to a Japanese bank and borrow, say, the equivalent of $2 billion in yen at basically 0% interest. Then it converts those yen into US dollars and buys American Treasury bonds, paying around 4.5% annually. The cost of borrowing, nearly nothing. The return on the investment, 4.5%. That spread, that gap between the two, is almost pure profit. No product, no service, no innovation required. Just geography and an interest rate differential doing all the work. Now you're probably thinking there has to be a catch. And there is. The catch is currency risk. If the yen strengthens against the dollar while you're holding this trade, your profits shrink or disappear entirely when you convert back. But for most of the past 3 decades, the yen was either weak or weakening, which meant the currency risk was manageable, often negligible. So institutions ran this trade on an enormous scale. Hedge funds, insurance companies, corporate treasuries. The capital flowing through this mechanism at its peak was measured in the trillions. And here's the part that matters for everyone watching this from the United States. All of that money had to go somewhere. It went into US Treasury bonds. That massive, sustained, relentless demand for American government debt kept Treasury yields lower than they would have been otherwise. Lower Treasury yields flowed directly into mortgage rates, car loan rates, and business lending rates. And every American who borrowed money at historically low rates over the past 2 decades was, without knowing it, a downstream beneficiary of Japanese monetary policy. Think about a software developer in his mid-30s, based in Austin, who locked in a 30-year mortgage at 3.1% in late 2020. He thought he got lucky with timing, and he did. But the timing was made possible, in part, by the yen carry trade keeping a ceiling on US borrowing costs. He didn't know that. He didn't need to. The mechanism worked whether anyone understood it or not. Then inflation returned to Japan. After 30 years of trying to generate it, it finally arrived. And it arrived faster than the Bank of Japan expected. By 2024 and into 2025, Japanese consumer prices were rising at rates the country hadn't seen since the 1980s. And this forced the Bank of Japan's hand. It started raising interest rates. Slowly at first, then with more conviction. And the moment Japanese rates started climbing, the carry trade's engine started misfiring. The spread narrowed. The math stopped working. Institutions began unwinding positions. The free money machine didn't break dramatically. It just quietly stopped printing. But what it leaves behind is a structural problem that goes much deeper than a trade unwinding. Because Japan's ability to keep running this whole system was never just about interest rates. It was always, underneath everything, a demographic story. There is a version of this story where Japan's debt problem eventually gets solved, where the economy grows fast enough, tax revenues rise, the debt-to-GDP ratio slowly comes down, and the whole thing stabilizes over time. That version exists. It just requires one thing Japan doesn't have: a growing population. Demographics is one of those topics that feels distant and academic until you trace the mechanism all the way to its conclusion. Then it stops feeling distant very quickly. Here's the basic engine of any modern economy. Working-age people go to jobs, they earn wages. The government takes a portion of those wages in taxes. Those taxes fund everything: roads, defense, social programs, and crucially, interest payments on government debt. When the working population grows, tax revenues grow. The government has more room to maneuver, and debt becomes more manageable over time simply because the economy expanding underneath it makes the ratio shrink. Japan's working population is not growing, it's contracting, and it has been for years. As of 2026, Japan's fertility rate sits at roughly 1.2 births per woman. To keep a population stable, you need about 2.1. Japan has been below that threshold for decades. The result is a population that is simultaneously shrinking in total size and skewing dramatically older. 1 in 3 Japanese citizens is currently over the age of 65. That number is heading higher. Now think about what that does to the fiscal math. Fewer workers means fewer people paying income taxes. A shrinking tax base means less revenue coming in. But an aging population doesn't reduce government spending. It explodes it. Healthcare costs rise. Pension obligations rise. Social support systems that were designed for a younger demographic get stretched across a much older one. You're collecting less and spending more at exactly the same time. Consider a budget analyst in his early 40s who manages household finances with the precision most people reserve for corporate spreadsheets. His income drops by 20%, but his fixed expenses, the mortgage, insurance, the car payment, don't move. And on top of that, his parents need financial support. The math doesn't bend because his situation changed. It just gets harder every single month. Japan is living that scenario at a national scale, with no obvious exit. And here's the thing that really closes the door on the easy solutions. The typical escape route from a debt problem is growth. But you grow your way out. The economy expands, revenues rise, and the debt ratio falls even without cutting a single program. But growth in a modern economy is driven largely by the size and productivity of the workforce. If the workforce is shrinking, growth becomes structurally limited. You can try to offset it with technology and productivity gains, and Japan has tried. But there are limits to how much output you can squeeze from a workforce that keeps getting smaller. Immigration could theoretically help. Many economists have pointed to it as the most direct lever available. But Japan has historically been one of the most restrictive developed nations on immigration. Cultural, political, and institutional resistance runs deep. The policy changes needed would take decades to show a meaningful demographic impact. And even if they started today, which at a meaningful scale, they haven't. So what you're left with is a country carrying 260% debt to GDP, with rising interest rates finally eating into its ability to service that debt cheaply, and no realistic internal mechanism to grow its way out. That pressure has to go somewhere. And increasingly, the place it's going is directly into your wallet. Understanding exactly how that transmission works, how a demographic crisis in Tokyo shows up in your mortgage payment, is what the next part is really about. Most people assume that what happens to their mortgage rate is driven by the Federal Reserve. The Fed raises rates, and borrowing gets more expensive. The Fed cuts rates, things loosen up. That's the mental model almost everyone carries. And it's not wrong exactly, it's just incomplete. Because sitting behind that entire system, for the past 3 decades, has been a buyer so large and so consistent that its presence shaped American borrowing costs in ways the Fed itself couldn't fully control. That buyer was Japan. Japanese institutions, pension funds, insurance companies, regional banks, became the single largest foreign holders of U.S. Treasury bonds over time. Not the second largest, not a major player, the largest. At peak holdings, Japanese investors owned somewhere in the neighborhood of $1.1 trillion in U.S. government debt. To put that in perspective, that's roughly the entire annual GDP of a country like Mexico, sitting in American bonds, collecting interest, and in the process, keeping U.S. Treasury yields lower than they would have been, with one less massive buyer in the room. Here's the mechanism, and it's worth walking through slowly, because this is the part that connects Tokyo to your kitchen table. When demand for U.S. Treasury bonds is high, their price goes up. When the price goes up, the yield, the effective interest rate, goes down. That's just how bonds work. More buyers competing for the same supply pushes the yield lower, and Treasury yields are the benchmark that mortgage rates are built on. The average 30-year fixed mortgage rate in the United States is typically priced at a spread above the 10-year Treasury yield. When the Treasury yield falls, mortgage rates follow. When it rises, so do they. So for years, Japanese capital flowing into U.S. Treasuries was quietly pushing mortgage rates lower than they otherwise would have been. Every American who bought a house, refinanced a loan, or carried a home equity line of credit during that period got a benefit they never knew existed. It wasn't policy, it wasn't charity, it was the downstream effect of Japan's carry trade, sending capital into the one market large enough to absorb it. Now that flow is reversing as the yen carry trade unwinds. Japanese institutions have less cheap capital to deploy abroad. Some are actively selling U.S. Treasury holdings to bring money back home, where rising domestic rates are finally making local investments worth holding again. Less buying means less upward pressure on bond prices. Less upward pressure on prices means yields rise. And rising yields mean one thing for anyone with a mortgage or anyone hoping to get one. Here's what that looks like in actual dollars. Take a home purchase in early 2026 with a $320,000 loan at a 6.5% mortgage rate. The monthly payment on principal and interest is roughly $2,023. Add 1% to that rate, bring it to 7.5%, and the same loan now costs $2,240 a month. That's $217 more every single month. Over 30 years, and that 1% difference adds up to $78,000 in additional interest paid by you, not because your credit changed, not because the Fed moved, but because one of America's biggest bond buyers quietly stepped back from the table. And it doesn't stop at mortgages. Rising Treasury yields make it more expensive for businesses to borrow and invest. That flows into hiring decisions and wage growth. It pushes down stock valuations because future corporate earnings are worth less when discounted at a higher rate. The 401k balance you check every quarter is sensitive to exactly this dynamic. The question now isn't whether this shift is happening. It clearly is. The question is how fast it moves and how much damage it does along the way. And that comes down to which of several scenarios actually plays out over the next few years. Whenever a long-running financial system starts to break down, there's a temptation to reach for the dramatic version of events: the crash, the crisis, the moment everything unravels at once. It makes for a better story, but the honest answer, and the more useful one, is that most structural shifts don't arrive as explosions. They arrive as a slow, compounding change in the cost of everything. And that's precisely what's worth preparing your thinking for here. There are three broad ways this Japanese debt unwind could play out from where we sit in early 2026. The first, and most likely, is what analysts have started calling the slow grind. In this scenario, the Bank of Japan raises rates gradually over several years. Japanese institutions reduce their U.S. Treasury exposure slowly, in measured steps. American yields drift higher, and not in a single lurch, but steadily over time. Mortgage rates settle into a range that makes the ultra-low rates of 2020 and 2021 feel like a historical anomaly, which, in hindsight, they almost certainly were. This scenario is manageable. It's uncomfortable, but it's the kind of discomfort that builds quietly and doesn't announce itself until you're already living with higher monthly payments and a refinance that no longer makes financial sense. The second scenario is a faster unwind, triggered by some external shock to the system: a sharp move in the yen, a sudden loss of confidence in Japanese government bonds, a geopolitical event that forces institutional hands. In this version, the unwinding that might have taken 5 years gets compressed into 12 to 18 months. Treasury yields spike, mortgage rates follow, and credit tightens faster than businesses and households can adjust. This scenario isn't a prediction, but it's worth knowing it's on the table, because the same mechanism that makes the slow grind manageable is also what makes the fast version so disruptive. The scale of Japanese holdings in American debt is simply too large to exit quickly without moving markets. The third scenario is a full-blown financial crisis centered in Japan itself: a sovereign debt spiral, a collapse in bond market confidence, the kind of event that gets a name in financial history books. This is the least likely of the three. Japan has tools still available, and its debt is almost entirely held domestically, which provides a buffer that most countries in debt trouble don't have. But least likely is not the same as impossible, and the downstream effects on global capital markets, including U.S. Treasuries, would be severe and fast. Here's the thing all three scenarios share: the direction is the same: higher borrowing costs. The only variable is the speed. So what does an informed person actually do with this? A financial planner in her early 40s, working with clients across the Midwest, has started having a specific conversation with anyone holding a traditional 60-40 portfolio: 60% stocks, 40% bonds. The assumption baked into that allocation is that when stocks fall, bonds rise, providing a cushion. But that relationship breaks down in an environment of rising yields. When yields go up, existing bond prices go down. Stocks and bonds can fall together. That's not a theoretical risk anymore. It's a dynamic that showed up clearly in 2022, and the conditions driving it haven't resolved. The era of ultra-low interest rates acted like a rising tide that quietly lifted every asset class simultaneously: stocks, bonds, real estate. It all went up together because money was cheap and looking for a home. That tide is going out, not all at once and not without interruption, but the direction is established. The single number worth watching is the 10-year Treasury yield. It's the benchmark everything else is priced against. When it moves steadily higher, mortgage rates follow. Corporate borrowing costs follow. Stock valuations compress. It's the one signal that ties all of this together in real time. If you see the 10-year yield climbing persistently through the back half of 2026 and into 2027, that's not noise. That's the structural shift making itself visible in the one place you can actually track it. Here is what this whole story actually comes down to. For 30 years, American borrowers were getting a subsidy they never knew existed: Japanese capital, cheap Japanese rates, and a carry trade running quietly in the background kept U.S. borrowing costs lower than they had any structural right to be. That era is ending, not dramatically, just permanently. A few things are worth carrying forward from this. Interest rates are not set in a vacuum. They are downstream of global capital flows you never see. The assets in your retirement account are priced against a benchmark that a Japanese pension fund helped shape, and the conventional wisdom about safe portfolios was built for a world that no longer exists in quite the same form. Watch the 10-year Treasury yield, not obsessively, but deliberately. It is the clearest signal available that this shift is accelerating or stabilizing. And here is the question worth sitting with. If one country's monetary experiment could quietly subsidize American borrowing for 3 decades without most people noticing, what other invisible dependencies are built into the financial system right now? And what happens when those unwind too? If this connected some dots for you, share it with someone who is trying to make sense of why borrowing feels harder than it used to. Subscribe if you want to keep pulling on threads like this one.